Let me say this clearly. Market bubbles don't fool beginners. They fool smart investors, people who know the numbers, people who've read the books. And if you think you are too rational to fall for one, that's exactly how they get you. Every major financial bubble in history shares one terrifying truth. At the peak, the smartest people in the room are still buying. They're not reckless. They're not stupid. They're confident. Confident that this time is different. Today, I'm going to show you how bubbles fool intelligent investors every single time using history, patterns, and the same warning signs we're seeing again right now. Stay with me because this isn't about panic. It's about survival. Every bubble begins with a true story. Not a lie. A real innovation. A real shift. A real opportunity. Railroads in the 1800s. Radio and automobiles in the 1920s. The internet in the 1990s. Housing in the 2000s. And today, AI, crypto, and can't-miss tech dominance. Here's the trick. The story is true. The price is the lie. Smart investors don't buy because of hype. They buy because the story makes sense. And that's the trap. Imagine a long-term chart. Prices rise slowly at first. Steady, logical growth. Then something changes. The slope gets steeper, then nearly vertical. That's not progress. That's emotion overpowering math. Here's where intelligence becomes a liability. Smart investors say things like, yes, it's expensive, but growth will justify it. Traditional valuation doesn't apply anymore. The market has changed. Sound familiar? In 1999, analysts said, clicks matter more than profits. In 2006, housing never falls nationally, in every bubble. This time is different. Warren Buffett calls this institutionalized rationalization. When prices rise fast enough, valuation feels old-fashioned, and that's when danger becomes invisible. Let me ask you something. When everyone around you is making money, how hard is it to stay out? Very hard. Bubbles don't grow because of greed alone. They grow because of social proof. Your colleagues are buying, your favorite analysts are bullish. Your portfolio underperforms if you stay cautious. At that point, not buying feels irresponsible. That's how smart investors stop asking, is this worth the price? And start asking, what if I'm wrong? That question destroys discipline. In early 2000, many professional investors knew valuations were insane, but they stayed invested anyway. Why? Because clients don't fire you for losing money with everyone else. They fire you for being early. Every bubble has a quiet phase near the top. Prices stop exploding. Volatility drops. Confidence peaks. This is the most dangerous moment. Why? Because investors say, see, it's stabilizing. But in reality, demand is exhausted. Picture a chart where prices go up fast, then move sideways. Volume fades, momentum slows, but headlines stay optimistic. This is where smart investors double down. Right before the break, here's another uncomfortable truth. Bubbles don't burst because of bad news. They burst because there are no buyers left. The trigger is usually something small. A rate hike, a weak earnings report, a policy change. But that's not the cause. The cause is overvaluation meeting reality. In 1929, it was tightening credit. In 2000, it was slowing growth. In 2008, it was defaults. Different stories. Same ending. Right before the fall, investors say, too much money on the sidelines. Central banks won't allow it. This asset is essential now. This is called normalcy bias. We assume tomorrow will look like yesterday. But markets don't break gradually. They break suddenly. Liquidity disappears. Prices gap down. And exits vanish. After every bubble bursts, the language changes overnight. Before, long-term fundamentals. After, no one could have seen this coming. But history says otherwise. The signs were always there. Extreme valuations, narrative-driven investing, dismissal of risk, moral certainty at the top. Bubbles don't hide. They dare you to challenge them. So what do disciplined investors do differently? They ask boring questions. What am I paying? What must go right to justify this price? What happens if growth slows? They accept underperformance during mania. They value cash. They survive. As Buffett says, you don't find out who's swimming naked until the tide goes out. Let me leave you with this. If an investment feels obvious, if skepticism feels stupid, if caution feels painful, you may be closer to a bubble than you think. Smart investors aren't immune. They're the primary targets. History doesn't repeat perfectly, but it rhymes loudly. And right now, the rhyme is getting very clear. If this helped you see the market more clearly, like this video, subscribe for calm, rational market warnings, not hype. And comment below, what asset do you think feels too obvious right now? Stay rational, stay patient.